I've been investing professionally for over 40 years. I've navigated 14 major market crashes. I've made billions of dollars by being on the right side of these moves. And I've learned lessons that cost me dearly when I was wrong. And after 4 decades of watching markets rise and fall, after studying every major crash in modern financial history, I can tell you with absolute certainty that crashes don't come out of nowhere. They're not random. They're not unpredictable acts of God. There are always warning signs, always patterns that repeat themselves with remarkable consistency. And if you know what to look for, you never have to be surprised by a crash again. Today, I am going to share with you the 4 warning signs that appear before every major market crash. These aren't theoretical concepts from academic papers. These are patterns I've observed personally, patterns that have saved me from catastrophic losses and allowed me to profit when others were being destroyed. I've seen these patterns in 1987. I've seen them in 2000. I've seen them in 2008. And I am seeing some of them emerge right now. But before I get into the 4 warning signs, let me take you back to a moment that changed everything for me. A moment that taught me more about market crashes than any textbook ever could. It was October 19th, 1987, Black Monday. I was in my office watching the screens, watching the market fall in a way that I had never seen before. The Dow Jones Industrial Average dropped over 22% in a single day, 22%. To put that in perspective, if that happened today, the Dow would fall over 9,000 points in one trading session. Trillions of dollars in wealth would evaporate in hours. I remember the chaos. I remember the phone lines jamming because so many people were trying to call their brokers. I remember traders who couldn't get out of their positions because there were no buyers, literally no buyers at any price. I remember thinking this might be the end of the financial system as we knew it. But here is what I remember most. In the weeks and months before Black Monday, every single one of the warning signs I am about to share with you was flashing red. The market had risen too far too fast. Valuations were stretched to extreme levels. Investors were using unprecedented amounts of leverage. And a new financial innovation called portfolio insurance was creating hidden risks that nobody fully understood. I had seen the warning signs. I had reduced my exposure. I had positioned myself defensively. And while that day was still terrifying, while I still had losses, I survived. I lived to invest another day. Many others weren't so lucky. Careers ended that day. Funds blew up. Lives were ruined, not because the crash was unpredictable, but because people ignored the warning signs that were right in front of them. That experience crystallized something for me. I became obsessed with understanding what causes crashes and how to identify them before they happen. I studied every major crash going back to the Dutch tulip mania in the 1600s. I analyzed the South Sea bubble, the panic of 1897, the crash of 1929, the bear markets of the 1970s, the emerging market crises of the 1990s, and of course the financial crisis of 2008. And what I found was remarkable. The same 4 warning signs appear before virtually every major crash. The details are different, the catalysts are different, but the underlying patterns are always the same. Let me walk you through each one. The first warning sign is excessive speculation and euphoria. When you see ordinary people making extraordinary returns with little effort, when you hear stories of your neighbor quitting his job to day trade, when taxi drivers and barbers are giving stock tips, when everyone believes they've discovered the secret to easy money, that is a warning sign. That is the market telling you that speculation has reached dangerous levels. Human psychology doesn't change. The same emotions that drove Dutch merchants to pay a year's salary for a single tulip bulb in 1637 are the same emotions that drive retail investors to pour money into meme stocks today. Greed, fear of missing out, the belief that you've discovered something others haven't, the conviction that this time really is different. These emotions are hardwired into our brains, and they express themselves in remarkably similar ways across centuries and across asset classes. I first truly understood this in the late 1990s during the dot-com bubble. I watched companies with no revenue, no profits, no viable business model trade at valuations in the billions of dollars. I watched people pour their life savings into companies they couldn't explain, buying stocks simply because the price had gone up and they expected it to keep going up. I watched the NASDAQ rise over 400% in just 4 years, creating paper millionaires everywhere. The speculation wasn't limited to professional investors. It was everywhere. College students were dropping out to day trade. People were taking out home equity loans to buy tech stocks. Chat rooms and message boards were full of people sharing tips, celebrating their gains, mocking anyone who suggested caution. The phrase, "This time is different," was on everyone's lips. They said the old rules of valuation didn't apply. They said the internet had changed everything. They said profits didn't matter because it was all about growth and eyeballs and click-through rates. I remember a specific moment that crystallized the insanity for me. I was at a dinner party, and a friend's wife, who had never shown any interest in investing, spent the entire evening telling me about the tech stocks she was buying. She was up 200% in 6 months. She told me I was a fool for being cautious, that I didn't understand the new economy. She was trading options on her lunch break. She was using margin to amplify her positions. She was certain she had figured out the secret to wealth that professional investors had missed. 6 months later, she had lost everything. Her entire portfolio gone. Her home equity loan, still owed. Her marriage, strained to breaking point by the financial stress. That story repeated itself millions of times across America in 2000 and 2001. Regular people who had been seduced by easy money, who had abandoned prudence and caution, who had bet their futures on stocks they didn't understand. They paid a terrible price. This kind of widespread speculation is a warning sign because it represents the final stage of a bull market. By the time everyone from taxi drivers to dentists to housewives is in the market and making money, there is nobody left to buy. The marginal buyer has already bought. All the potential capital that could flow into stocks has already flowed. The only thing that can happen next is selling. And when selling begins, when the psychology shifts from greed to fear, the decline can be sudden and severe because there are no more buyers to cushion the fall. I look for several specific indicators of excessive speculation. First, I look at valuations, our price to earnings ratios at historical extremes. Are companies trading at multiples that require decades of perfect execution to justify the Shiller-Cape ratio, which looks at prices relative to 10-year average earnings, is something I watch closely when it gets above 25 or 30. History says returns over the next decade will be poor. When it gets above 40, as it did in 2000, you are in dangerous territory. Second, I look at leverage. Are investors borrowing heavily to buy stocks? Is margin debt at record levels? Margin debt tends to peak right before crashes and trough, right before recoveries. It is a wonderful contrarian indicator. When margin debt is at record highs relative to the size of the market, investors are maximally exposed and maximally vulnerable. Third, I look at breadth. Are a small number of stocks driving all the gains while the rest of the market languishes? This kind of narrow leadership is often a sign of a market in trouble. Healthy bull markets have broad participation. Unhealthy ones are held up by a handful of leaders, while the majority of stocks decline. We saw this in 1999 with tech stocks, and we've seen something similar more recently with the mega-cap technology companies. Fourth, I look at retail participation. When retail investors are flooding into the market, when trading apps are reporting record signups, when meme stocks are dominating the headlines, speculation has reached dangerous levels. Retail investors tend to be wrong at extremes. They buy heavily at tops and sell at bottoms. Their enthusiasm is a contrary indicator, right? Now, as I look at the market, I see some troubling signs. Valuations in certain sectors are stretched. The AI enthusiasm has created pockets of extreme speculation. Companies are being valued as if artificial intelligence will transform their businesses overnight. regardless of whether they have any actual AI capabilities. We have seen episodes of meme stock frenzy, of retail traders piling into options, of social media influencers touting stocks. They don't understand. I am not saying we're at 1999 levels yet, but I am watching carefully. The seeds of speculation have been planted, and they tend to grow until they become dangerous. The second warning sign is leverage and credit excess. Every major crash in history has been accompanied by, and usually caused by, excessive leverage in the financial system. When people borrow too much, when institutions take on too much debt, when the entire system becomes dependent on cheap and abundant credit, you have created the conditions for a crash. Leverage is the accelerant that turns a small fire into an inferno. Let me explain why leverage is so dangerous. When you buy something with borrowed money, your gains are amplified. If you put 20% down and the asset rises 10%, you've made 50% on your equity. That feels great on the way up. It makes you feel like a genius. It makes you want to borrow even more. But the reverse is also true. If the asset falls 10%, you've lost 50%. And if it falls 20%, you are wiped out. Your entire investment is gone, not diminished, gone. Now multiply that dynamic across millions of investors and trillions of dollars. When leverage is high and prices start to fall, leveraged investors are forced to sell. They have no choice. They have to meet margin calls. They have to reduce risk. They have to come up with money they don't have. That forced selling pushes prices lower, which triggers more margin calls, which causes more selling. It becomes a self-reinforcing spiral that feeds on itself, a vicious cycle that can take prices far below any reasonable estimate of value. This is why crashes overshoot. They don't stop at fair value. They go below fair value, sometimes far below. Because forced selling has nothing to do with value. It is about survival. When the margin call comes, you sell at whatever price you can get, because the alternative is losing everything. And when millions of people are getting margin calls simultaneously, prices can collapse to levels that would seem impossible in normal times. In 1929, investors were buying stocks on 10% margin. They could control $100 of stock with just $10 of their own money. The leverage was 10 to 1. When the market started falling, the margin calls came fast and furious. Investors who couldn't meet the calls had their positions liquidated. The forced selling crashed prices further, triggering more margin calls, more selling, more crashes. The cascade was unstoppable. The market fell nearly 90% from peak to trough over the following 3 years. In 2008, the leverage was hidden in complex financial instruments that even the people trading them didn't fully understand. Banks were leveraged 30 to 1 or more. Lehman Brothers was leveraged over 30 to 1 when it failed. That meant a decline of just 3% in their asset values would wipe out all their equity. The entire financial system was built on the assumption that housing prices would never fall nationally. When that assumption proved wrong, the leverage unwound catastrophically. Banks failed. Credit markets froze. Companies couldn't get short. Term financing to make payroll. The global economy came within days of complete collapse. I remember those weeks in September and October of 2008. I remember looking at positions on my screen and not knowing what they were worth because there were no prices. Markets had stopped functioning. Counterparties were failing. The leverage that had amplified gains on the way up was now destroying everything on the way down. It was the closest I've ever come to thinking the financial system might actually break. Today I watch leverage carefully across multiple dimensions. I look at corporate debt levels. Are companies borrowing heavily to buy back stock, to fund acquisitions, to pay dividends they can't afford? Corporate debt as a percentage of GDP is at near record levels. Companies have taken advantage of low interest rates to borrow trillions. Some of that borrowing was productive. Much of it was just financial engineering to boost share prices. When the next recession comes and earnings fall, many of these companies will struggle to service their debt. I look at consumer debt. Are households stretched? Are they borrowing to maintain living standards? Credit card debt. auto loans, student loans, mortgage debt. All of these are elevated. The American consumer has been remarkably resilient, but they're walking on thin ice. I look at government debt, which, as I've discussed extensively elsewhere, is at unprecedented and dangerous levels. Over $35 trillion and growing by $2 trillion per year. The interest expense alone is now over $1 trillion per year. This is the slow-moving leverage crisis that nobody wants to talk about. I also look at leverage in the financial system itself. What are hedge funds doing? What are banks doing? Where is the hidden leverage that nobody is talking about? Often the most dangerous leverage is the leverage you can't see, the leverage embedded in derivatives and structured products and private credit funds. In 2008, nobody realized how much leverage was hidden in mortgage-backed securities and credit default swaps until it was too late. One thing I've learned is that leverage tends to be highest precisely when people are most confident that nothing can go wrong. Low volatility breeds complacency, and complacency breeds leverage. When the VIX is low, when credit spreads are tight, when everyone believes the Fed has eliminated risk, that is when leverage is building most dangerously. The calm before the storm is when the greatest risks are being taken. That is when banks are lending most aggressively. That is when investors are using the most margin. That is when the next crisis is being constructed. The third warning sign is new financial innovations that nobody fully understands. Every crash features some new financial product, some new structure, some new way of doing things that seems brilliant at the time but turns out to have hidden risks that nobody appreciated. Financial innovation sounds like progress, and sometimes it is, but more often it is a way to hide risk, to add leverage, to convince people that they can earn high returns without taking high risk. In the 1920s, the innovation was investment trusts. These were like early mutual funds, but they could borrow money and invest in other investment trusts. The leverage became layered on top of leverage when the market turned. These structures collapsed spectacularly in 1987. The innovation was portfolio insurance. This was a strategy that used futures contracts to automatically sell as prices fell, supposedly providing downside protection. It seemed like a brilliant idea. You could own stocks and have insurance against a crash. But what nobody considered was what would happen if everyone used portfolio insurance at the same time. On Black Monday, the portfolio insurance programs all tried to sell simultaneously. There weren't enough buyers. The forced selling overwhelmed the market. The innovation designed to prevent a crash actually caused a crash. In 2008, the innovations were mortgage-backed securities, collateralized debt obligations, and credit default swaps. These instruments sliced and diced and repackaged risk in ways that made it seem to disappear. AAA ratings were slapped on securities backed by subprime mortgages. The rating agencies said these were as safe as treasury bonds. Investors bought them in massive quantities, believing they had found a way to earn high yields without high risk. They were wrong. The innovation had hidden the risk, not eliminated it. Today, I worry about several new innovations that have the potential to cause problems. I worry about the growth of private credit, the lending done outside the traditional banking system. This market has exploded in size, but is much less transparent than traditional bank lending. I worry about the basis trade in treasury markets, where hedge funds are using enormous leverage to exploit small price discrepancies. I worry about the proliferation of zero-day options and the complex trading strategies built around them. I worry about cryptocurrency and the stable coins and the lending protocols built on top of them. I am not saying any of these things will cause the next crash. I am saying that whenever you see rapid growth in financial products that nobody fully understands, that regulators aren't watching closely, that promise high returns with low risk, you should be on alert. History tells us that these innovations often end badly. The fourth warning sign is policy mistakes by central banks and governments. Crashes are often triggered or amplified by errors in monetary and fiscal policy. Sometimes the mistake is keeping policy too loose for too long, allowing bubbles to inflate. Sometimes it is tightening too aggressively, popping bubbles in a disorderly way. Sometimes it is failing to act when action is needed. In almost every crash, you can point to policy decisions that made things worse. Central bankers and politicians are human beings. They have the same cognitive biases, the same blind spots, the same tendency to fight the last war that the rest of us have. They operate in a political environment that rewards short-term thinking and punishes tough decisions. They have imperfect information and imperfect tools, and they make mistakes. Sometimes small mistakes, sometimes catastrophic ones. In the 1920s, the Federal Reserve kept money too loose during the boom, allowing speculation to reach dangerous levels. Credit was cheap and abundant. Margin lending was essentially unregulated. The stock market became a national casino, and the Fed did nothing to stop it. Then after the crash, they tightened policy when they should have loosened, allowing the money supply to contract by a third. They turned what could have been a sharp recession into the Great Depression, the worst economic catastrophe in American history. The policy mistake didn't cause the crash, but it made the aftermath immeasurably worse. In 2000 and 2001, the Fed had kept rates low after the Asian financial crisis and the Y2K fears, providing fuel for the technology bubble. Greenspan famously talked about irrational exuberance in 1996, but he didn't actually do anything about it. The bubble continued to inflate for 4 more years. By the time it popped, the excess was so extreme that the fallout was severe. And then, in response to that crash, the Fed cut rates to 1% and kept them there too long, setting up the housing bubble that would cause even greater devastation. In 2008, there were policy mistakes at every level. Regulators failed to supervise the mortgage market. Lending standards deteriorated to absurd levels. No income verification, no down payment, adjustable rate mortgages with teaser rates that borrowers couldn't afford once they reset. The SEC allowed investment banks to increase leverage, letting them balloon their balance sheets with minimal capital. The rating agencies gave triple ratings to securities that were anything but safe. The Fed kept rates too low for too long after the dot-com bust, encouraging housing speculation and making credit too cheap. And then when the crisis hit, initial policy responses were slow and inadequate. The authorities let Bear Stearns be rescued, but let Lehman Brothers fail, creating panic and uncertainty about who would be saved and who wouldn't. The decision to let Lehman fail turned a serious crisis into an existential one. Credit markets froze overnight. The commercial paper market stopped functioning. Money market funds broke the buck. The entire financial system was hours away from collapse before the government finally stepped in with overwhelming force. Today, I watch policy very carefully. The Federal Reserve has an incredibly difficult job. They're trying to bring down inflation without causing a recession, what economists call a soft landing. They're trying to normalize rates without breaking things. They're trying to shrink their balance sheet, the quantitative tightening, without disrupting markets so far. They've managed reasonably well, but the margin for error is small, and the path ahead is treacherous. I also watch fiscal policy, which I believe is the bigger long-term risk. We're running $2 trillion deficits during an economic expansion. We have no plan to address entitlement spending. The Social Security and Medicare trust funds are marching toward insolvency. We're piling debt on top of debt with no end in sight. This isn't a policy mistake in the traditional sense of doing the wrong thing in a crisis. It is a slow-motion policy catastrophe that is creating the conditions for a future crisis. It is like watching someone smoke 3 packs a day and knowing that cancer is coming, even if you can't predict exactly when. What worries me most is that policymakers have very little ammunition left. In a normal recession, the Fed cuts rates by 400 to 500 basis points or more to stimulate the economy. But if rates are already low when the next recession hits, they can't cut that much. They'll quickly hit zero and be forced into unconventional measures like quantitative easing, which has diminishing returns. In a normal recession, The government increases spending to stimulate demand. But if they're already running massive deficits, if the debt is already over 100% of GDP, how much more can they borrow? The tools that rescued us from past crashes may not be available or may not be as effective when we need them again. This is why I believe the next crash could be more severe than past ones. Not because the trigger will be worse, but because the policy response will be more constrained. We've used up our ammunition in peacetime. We've run deficits when we should have been saving. We've kept rates low when we should have been normalizing. And now, when the next crisis comes, we'll face it with fewer tools and less room to maneuver. Now let me bring these 4 warning signs together and talk about what I am seeing right now, because the question everyone wants answered is whether a crash is imminent. The honest answer is, I don't know. Nobody knows. If anyone tells you they know exactly when the next crash will happen, they're lying or deluded. Markets can remain irrational longer than you can remain solvent. Bubbles can inflate far beyond what any reasonable person would expect. Timing is impossible. But I can tell you what the warning signs are telling me right now. On speculation and euphoria, I see mixed signals. There are pockets of extreme speculation, particularly in AI-related stocks and in certain areas of crypto. But I don't see the universal euphoria that characterized 2000 or 2007. Most investors I talk to are actually somewhat cautious. They remember the pain of past crashes. That is different from the typical blow-off top where everyone is bullish. On leverage, I am more concerned. Corporate debt is high. Government debt is at unprecedented levels. There is leverage in the financial system that I can't fully measure in private credit, in hedge fund strategies, in derivative markets. The total amount of debt in the system is a multiple of what it was before 2008. That doesn't mean a crash is imminent, but it means that when a crash does come, the leverage will amplify it. On financial innovation, I see risks building in areas like private credit and complex options strategies. But I haven't yet identified the specific innovation that will be the center of the next crisis. It is out there somewhere. These things only become obvious in retrospect. Right now, I am watching and trying to identify where the hidden risks are accumulating. On policy, I am very concerned about fiscal policy and somewhat concerned about monetary policy. The Fed is navigating a difficult path, and so far they've done a reasonable job. But the fiscal situation is deteriorating rapidly, and there is no political will to address it. This isn't the kind of thing that triggers an immediate crash. It is the kind of thing that creates the conditions for a bigger crash later. So what do I do with this information? How do I position myself when I see warning signs but don't know when a crash will come? First, I make sure I can survive a crash. I don't use so much leverage that a sudden decline would wipe me out. I maintain liquidity. I have positions I can exit quickly if I need to. Survival is the first priority. You can't profit from a recovery if you don't survive the crash second. I stay invested but stay alert. Selling everything and going to cash because you are worried about a crash is usually a mistake. The opportunity cost of being out of the market can be enormous. What I do instead is maintain positions but reduce risk around the edges. Trim positions that have become too large. Avoid adding to positions at extreme valuations. Keep some powder dry for opportunities. Third, I look for hedges. There are ways to protect a portfolio against crashes without sacrificing all the upside. Options can provide insurance. Certain assets tend to do well when others crash. Gold, treasury bonds, in certain scenarios, inverse funds. I always have some hedges in place, not so many that they drag down returns in good times, but enough to cushion the blow if things go wrong. Fourth, I pay attention to the narrative. Markets don't crash just because valuations are high or leverage is excessive. They need a trigger, something that changes the narrative, that shifts the mood from greed to fear. Often it is something nobody expected, a geopolitical event, a major fraud discovered, a policy surprise. I can't predict what the trigger will be, but I can stay alert and be ready to act quickly when the narrative starts to shift. Let me share one more lesson from my career. The most money I've ever made hasn't been in normal markets. It has been during periods of dislocation, during crashes and crises when prices become completely detached from reality. The financial crisis of 2008 was terrifying, but it also presented some of the best buying opportunities of my lifetime. Companies with strong fundamentals trading at a fraction of their value because forced sellers had to liquidate regardless of price. This is the silver lining of crashes. They create opportunity. If you've heeded the warning signs, if you've survived with capital intact, if you've stayed patient and disciplined, you can profit enormously from the panic of others. That is not callousness. That is providing liquidity when liquidity is scarce. That is buying when others are forced to sell. That is the essence of successful investing. The 4 warning signs I've shared with you today are not a crystal ball. They won't tell you exactly when to sell or exactly when to buy. Markets are too complex, too influenced by human psychology, too subject to random events for anyone to predict their movements with precision. But these warning signs will help you understand the risks you are taking. They'll help you avoid being blindsided. They'll help you stay alert when others are complacent and stay calm when others are panicking. They'll help you survive. And survival is what matters most. The investors who build fortunes over their lifetimes are not the ones who make the biggest gains in any single year. They're the ones who avoid the catastrophic losses. They're the ones who are still standing after the crashes, with capital intact, ready to buy when prices are cheap. You cannot compound your wealth if you lose 50 or 60 or 70% in a crash. The mathematics of loss are brutal. A 50% loss requires a 100% gain just to get back to even. That is why avoiding crashes, or at least minimizing your exposure to them, is so important. Speculation and euphoria, leverage and credit excess. Financial innovations nobody understands. Policy mistakes by those in charge. These are the harbingers of crashes. They've appeared before every major market crash in history, and they'll appear before the next one. The patterns are consistent. The human psychology is consistent. Only the details change. The question is whether you'll be watching for them, whether you'll have the discipline to reduce risk when you see them building, whether you'll have the courage to act when everyone around you is celebrating gains and mocking caution. That discipline, that courage, that awareness is what separates investors who survive crashes from those who are destroyed by them. It is what separates those who build lasting wealth from those who see their fortunes evaporate. I've been through enough crashes to know that this one thing is true. The warnings are always there for those who choose to see them. The only question is whether you are looking